All right, hello everyone. Welcome to this week's weekly market recap. A little bit of a new setup for us, so hopefully you enjoy it and we'll get some better engagement. So we're recording this on Thursday, and you're probably going to receive it on Friday, but a lot has been going on. Two other regional banks has failed, or their stock has collapsed more than 90%. We had the Fed decision yesterday on Wednesday. Fed increased the rates the 10th straight time to 5.25%. So what are the implications on the market? We'll take a look at the SPY, we'll take a look at the indices, and we'll basically see what's happening in the market. So it's going to be a long video, so without further ado, let's get started. So today, most of the indexes, closed in the red area. So Dow down about 83 percentage of a point. SPY down about 75 basis point. Same with Bitcoin. Bitcoin is also selling off. On a weekly basis, the only sectors that are slightly green is healthcare and industrial. Industrial is kind of flat, and then consumer staple is only down about 48 basis points. So these are the defensive sectors. Again, we saw with the banks and everything that's going on, a lot of money was flowing into the defensive names, especially healthcare. And of course, financials and energy were the worst performers. We know energy is an input cost for a lot of stocks, a lot of things that we do in our life is an input cost. So energy usually leads into what's going to happen in the economy. So whenever energy gets really weak, that usually signals that, hey, a recession is on the way. Also today after hours, we had earnings from DoorDash. So you can see DoorDash is up slightly, about 7%. We also had earnings from Apple. So let's go ahead and take a look and see how Apple is doing. Apparently they had a really good earning, and I think stock's gapping up. Apple, they beat their earning as well as their revenue estimate. The stock went up, but now it's finding its way down. I mean, Apple, when you look at the daily chart on the Apple, the move was really priced in. So the stock has been moving up since March with a lot of the big tech. So I don't know if we can expect Apple making all-time high in this environment. So, if you actually go a little further back, Apple is almost making, let me go to a 1 month chart here. You can see Apple is almost making all-time high when you compare it. So I don't know if we can expect much more move from Apple despite an amazing earnings that they had. So let's go to our agenda. So we're going to talk about the Powell comment yesterday on Wednesday. We'll talk about the regional bank situation and what's happening and what it means and how we can trade around it. I actually traded one of the regional banks today myself. I'll spend a little bit. I think a lot of people are interested to know why actually banks are failing, why the Fed is not cutting rate despite seeing so many banks having problems. So we'll talk about a little bit about that dynamic as well, and the fact that Fed really cannot do much here in this situation. And we'll take a look at the SPY and we'll come up with some trade ideas. A couple of interesting things happened yesterday. So Powell, he was asked obviously about the banking situation, and his response was that the banking condition in US is safe and sound. And a lot of people, especially on Twitter, really compared it to Fed chair at the time in 2007, Bernanke, when he was asked about subprime mortgages, and he said the subprime losses are most likely contained. And going back in time, we definitely know that was not the case. The subprime losses were not contained. So obviously it spilled over to the whole insurance business, to the whole banking situation, and obviously at the end it spilled over to the economy, and we had that massive kind of great recession that we experienced. So is Powell the next Bernanke? That's really the title of, should be the title of this video. When we're looking at different hiking cycle, and this is very interesting, and I wanted to talk about the dynamic that we're experiencing. This, on a green line, you see ISM manufacturing, and you can kind of see that whenever ISM manufacturing is going down, usually Fed start easing. So they start cutting rates. So you can kind of see it in 2020, you can see it in 2008, you can see it in the 2000 recession, almost always. But this time around, the ISM has been signaling a massive slowdown, but the Fed is actually hiking into a slowdown. And we hate this expression of this time will be different, but I have a really strong feeling that this time actually is going to be different. And the reason for that is Fed can't really cut rates. Why? The answer is in the next slide. This time is different because, as you can see, let me get this, because as you can see, inflation is not really coming down. So when you compare inflation from, let's say, the 2013 to 2020, now this is a 7-year, 8-year sample. It's a pretty good sample. You can kind of see it's been really hovering around this 2%, right? And what happened after the pandemic with all the stimulus that we injected into the economy, the supply chain disruption, again, this is a trim mean PCE. This is something that Fed really likes to look at. And the blue one is just a year-over-year PCE. You can kind of see it. It's not coming down. It's really now hovering around this 4 or 5%. There is no sign of this coming down to 2%. That's one of the problems with inflation. You know, when inflation gets unanchored, and that's why it's so important. Once it starts getting out of control, once workers start demanding 5%, 6% raise, once manufacturing raises their price by 5, 6%, very unlikely they're going to come down, right? So, now probably the inflation is going to start mean reverting in this higher level. And this is something that Fed does not want. And this is one of the reasons why I told you this time is going to be different. They can't really cut this time around. Again, labor costs. When it comes to labor costs, we've talked about this a lot. The labor cost is the biggest input cost, right? Like for our business, we're running, at trading terminal, at Bearable Traders, labor is our biggest cost. Every other business, I know a lot of you guys are business owners. The biggest cost is your labor. And, employment cost index, this is a report that comes out every quarter. And this is the best measure of how expensive labor is getting. You can see it's unhinged, right? It has been increasing. It's coming down slowly, but still a lot higher. Again, on a year-over-year basis, you can see it moved from the 2%, and now it's in these new areas of the 4%. So it's going to be a lot harder to really manage this expectation. So, regional banks are having a problem. So I want to spend a little bit of time about the dynamic of what's happening with the regional banks. I think it's going to be really helpful for people to really understand, okay, what's going on and what can the Fed do, and if whether or not, they short the banks or not. So let's, come here in this blank slide and really explain to you one basic how banking really works on a really basic 101 basis. So, on one side of the accounting equation, you have asset equal liability plus equities, right? And, you can think of it as, if you bring the liabilities to this side, asset minus what you own minus what you owe is your net worth. So, think of it as your house, how much mortgage you have, how much down payment you have. It's really easy to understand that way. Asset for the banks really is the bonds that they own, right? And the liabilities is the deposit that they have. So, when a lot of the banks bought, 1%, 2% mortgage rates as their assets, and obviously as the rates went up, the value of this asset came down by a lot, but their deposit didn't really move much. So what happened is now this side of the equation have to match this side of the equation. So that means their equity has to come down. And when the equity is really coming down, this is the problem when you get to insolvency, right? That's the network of the bank. The bank gets basically insolvent. So that's basically what's been happening with a lot of the banks. You can kind of see there is a massive shrinkage of deposit happening in majority of the banks, and this is the 12 months year-over-year difference. And you can see whenever there is this much contraction in amount of deposit, it usually is followed by areas of a slow growth in the economy. Another interesting thing that happened this week was Powell speaking and talking about how the banking system is sound and safe. And I really like this chart. And this is when the statement came out. This is the chart of regional banks. And this is when Powell was done with his press conference. And as you can see, he kept saying the banking system is fine, but the stock was telling him it's not the case, right? The market was telling him he's lying, and the stocks were completely selling off. Again, this is exactly when a market closed, Powell was done talking, and this is PacWest shares that, they had to go under as well, and their stock dropped by over like 40% over a span of few minutes. So all eyes are going to be on tomorrow's economic data. So let's go ahead to our calendar page in our trading terminal, and let's go to our economic page and take a look at the data. So tomorrow we're going to have the job numbers. So this is probably a market moving event, average hourly earning, non-farm payrolls, manufacturing payrolls. So all of this stuff are going to be highly watched. So non-farm payrolls coming out at 8:30 in the morning. unemployment rates. With the jobless claim that we got today, it is very unlikely that we see job losses tomorrow. So we're probably still gonna see net job gains, which again shows how resilient the labor market is. As far as next week go on the economic calendar side, let's see what we have. Doesn't seem like a very busy week next week, but of course we have the Michigan 5-year inflation expectation. That could be a market moving event. And on the earnings side, next week we have, let's take a look. We have Airbnb, Oxy, PayPal reporting, Toyota, Disney is reporting. So a couple of big name. Which one is this one? JD is reporting. Yeah, so a couple of big names are actually reporting. So it's going to be a busy week. And I think by the week after, almost 90% of all the S&P 500 companies have reported their earnings. So we get a good idea if the earning estimate, the future earning estimate has actually bottomed and is now ticking up, or no, we're still in an earning recession. Lots of stuff to see, so let us know what you think. What are you trading, and if there's any trading opportunities, if there's anything you like me to cover, let me know in the comment section, and let me know if you like the new setup and the new format. Of course, you can let us know by your likes and your comments. Thank you.